Do you feel like investing is just gambling? Well, I'm going to show you why some people feel that way and how to avoid gambling with your investments. Welcome, new and returning Money Buddies. Today's episode is going to be a fantastic one. I had this idea come to me a couple days ago, and so I'm super pumped to share with each and every one of you. You know how so many people feel like investing is just gambling and they stay completely away from it? They think, oh, I'm not going to gamble on the stock market. While I certainly think there are aspects of trading that are like gambling, I'm going to show you today how investing doesn't have to be like gambling. We're going to look at both sides of the coin today. We're going to break down the difference between trading and what actually feels like gambling and what is true investing. I have a great episode lined up for you today. I'm going to start out with a story about how I almost fell into the same trap that so many people in our generation are falling into and what all these apps are trying to get us trapped into. And then today's research segment is going to really dive into how day trading is a whole lot more like gambling and how it's not going to make you any money, if we're being honest. And then I'm going to show you how you can take a more long-term approach to investing and true investing, not just trading and potential speculation and even gambling on your investments. And then in today's case study, we're going to walk through a specific story that is so much like all of us and how we get caught up in the advertising and all these different investing apps and how it leaves us feeling like we're just being left in the dark and how we're being left behind and we're not really making any money. And then I'm going to show you how to go from a point of where you feel like you don't have a true strategy to building a true investment strategy that's going to help you really invest for the future and invest for your long-term goals. Thank you so much to all of you for listening to the show. The show is growing at a fantastic rate, and I'm super excited to keep it going and continue getting new listeners. So as we get started here, have you ever had a friend or a family member tell you that investing is just gambling? Well, today we're going to prove how it's not and compare the different areas between trading and investing. So share this episode with a friend so that we can prove how investing isn't gambling, but how there might be some aspects to trading that are similar to gambling. Investing versus trading are two completely different things, and I think that's where people get caught up in thinking investing is gambling. They're probably more likely thinking of speculating and trading. Investing is putting your money away for the long term and letting it grow, whereas trading is trying to get rich quickly, and you're trying to make some big profit off some sort of anomaly in the stock market. There's only one way that's going to truly make you long-term wealth, and I'm going to show you that today. So let's get into today's story about how I almost succumbed to the marketing and the hype around trading and speculation. About 6 or 7 years ago, I wanted to start investing. I was coming out of high school. I wanted to start having my money grow for the long term, right? We'd heard all this great news about compound interest, and I wasn't sure how to invest or frankly what to invest in. Thankfully, I was listening to a lot of different financial podcasts and started to hear some ideas around index funds, but I started out on an app called public.com. Their whole approach was creating a social network to follow people in their investing. There was a feed of trades that your friends made or a feed of trades that people you followed would make. And honestly, it was just trying to get you to trade more by showing you trades that other people were making. And I think it was extremely manipulative and extremely deceptive because it was trying to get people to trade and essentially gamble or speculate their money based on what other people were doing instead of having a real long-term strategy because they were just in it to make money off of those trades that everyone was making. And that's what's so tricky about all these different investing apps is they're just trying to make money off of your trades. That's how they get paid. And I'll show that in today's research segment with an article about Robinhood, one of the worst apps that you could use for investing. But back to my story, I wanted to start investing. So I did, which was great. It was awesome to start investing. And I was at least being careful about picking stocks. I was avoiding picking gambling type stocks or penny stocks, and I was using index funds. I wasn't trying anything specific or using a good index fund. I just was finding whatever looked cool, right? I wasn't taught anything like so many of us. We weren't taught how to invest money. I didn't have any education around the different types of investments or the different type of index funds like the S&P 500. But now the issue that got in the way for me and for the way of all of us is there's so many different apps. There's so many different accounts out there. It's so confusing when you're just trying to get started with investing. I had an account with Public. I had an account with M1 Finance. I had a 401k with this random company called Milliman, whatever that is. I had heard about Fidelity, I'd heard about Vanguard, but how do you actually open accounts with them? Should I open an account with them? My credit union offered an IRA. Should I open an account there? There are so many different places to invest. And this is what's so conflicting and so troublesome about all of it is you have these apps that are trying to advertise to young adults and manipulate them into making more trades so they can make money off of them. And there's so many different things out there. And let's not forget about crypto. Are we supposed to invest in that? What are we even supposed to do with crypto? What in the world is I actually supposed to invest in? I'm sure you've all felt this way because I know I have, where you're not really sure what to actually do with your money, but you want to start investing and you want to start making it grow for the long term. Well, the big change for me came from the Money Guy show. They talked about how you need to keep your financial life simple because complexity is going to naturally find you. So if you set it up with a simple approach, it's going to make it a whole lot easier down the road. And man, was that true. So that's what I started doing. I started to make it a whole lot more simple. And I finally, after a few years, have gotten all my investing into one location with Fidelity. It took years, literally years to get it to this point because I started out by opening a new account at Fidelity. I would let my other accounts grow over time. I would roll over old 401k accounts into this Fidelity account. It was really beginning to take shape that I was moving everything to one place. And then letting my accounts grow is one of the key pieces here because Fidelity will actually reimburse you transfer fees if you have over $25,000. So once I hit that point, I knew it was time to pull the trigger on all my different IRA accounts that were out there. So it was a very slow and steady process. So don't feel like you have to go change your entire financial account structure in one day because it's going to take some time. Start by simply opening a new account at Fidelity or Vanguard and set up your simple investing strategy there. We're going to talk more about investing strategies in today's case study, but make it simple and easy and then slowly work on bringing everything else over. I like to invest strictly in index funds. My taxable account is in AVUV and VOO, a 50-50 split. And then all my other accounts are in FZROX. AVUV and VOO are ETF index funds. They trade like a stock and they're based on an index fund, whereas FZROX is a mutual fund. It's a different type of investment, but it's still based on an index fund. I keep it simple with those large index funds that are either the entire stock market or an entire sector like small cap, like AVUV. There's a lot of different things you can learn there, and I would recommend doing more research on your own before you pick a specific stock, but I just wanted to let you know what I invest in. And honestly, right now, I'm not too worried about diversifying in a bunch of complex ways because I just don't have enough money in the account yet. I think that there's a certain threshold where diversification can be important. I think it's around $100,000. So if you're below that, just worry about getting money into the account. Get money into these index funds and just keep chugging away at it. And then as it grows, you can work with a professional or you can learn more about diversification. But just start with simple index funds because implementing this simple investing strategy is going to get you to a point where, like my wife and I, you just have a simple approach that is so much easier and you don't have to worry so much about all the different investments, all the different stocks you're invested in. You can stick to one plan and just let it grow over time. And honestly, we have it in our plan that I can update our investing strategy no more than once a quarter. Guess how many times I have updated it since we put this strategy in place? One time. You know how many quarters there have been? Many. Too many to count. It's been a long time, but I've really never updated our strategy because we just let it grow. And I don't have to worry about it anymore. All of our money's in one place with Fidelity and it's super simple and easy. I check the account maybe once, maybe twice a month, and there's even been a period or two where I've gone 2 to 3 months without looking at our investing accounts. Now, I highly doubt any of those trading apps out there are going to let you go 1 or 2 months without trading because they're going to start bombarding you with notifications, right? They want you to trade. But ultimately, investing in my life now is so much easier and simple because of the index fund approach. And I really want to encourage each and every one of you to consider investing instead of trading. Make it so that you don't have to worry about some magical way to trade your way to wealth because honestly, it's not going to work anyways, and I have the research to prove it. And I'm excited to show you some articles today that are going to show you how you're not going to get wealthy trading. And that is what's a lot more like gambling than you think. So let's get into today's research segment. So to kick off today's research segment, I want to open with an article titled, "Is Day Trading a Form of Gambling?" And the first quote to share here says, "Day trading is buying and selling stocks or assets within a day or even within seconds. It's not about investing, but taking advantage of ups and downs and price movements during a trading session." And this right here is one of the key reasons why people say investing feels like gambling. They're often thinking about day trading Because if you are doing day trading like gambling, it's extremely often that it's relied on luck. And I have some more research to show that. This next quote says, while day trading is not considered gambling, some people find it easy to get caught up in the ups and downs of the activity, whether winning or losing, as the thrill can be a rush of adrenaline and lead to an addictive cycle. This behavior can also lead to significant financial losses, which can motivate a person to continue hoping to recover them. This is where I think it is so much more like gambling, because it's easy to get caught up in the activity and get caught up in the adrenaline. That thrill of adrenaline is what makes day trading addictive and much more like gambling, because if you lose money trading, it makes you want to take more risk. And it's just like gambling in that sense. When people think investing is gambling, they're more likely thinking about day trading, because that is what can be so much more addictive and lead to so much bigger losses, and people borrowing money to invest more or stealing money from family to invest more, thinking they're going to hit it big and really win with one of their day trades. But we got some stats today to show you how that is so unlikely. The next quote here says the success rate of day trading is low due to its risk and requiring considerable skill. Good timing and luck also play a huge role. Some studies show that 80% of day traders fail within a year. Now, why is day trading so hard? Well, it's hard because of computers. For the same reason that you can access all the information that you need to make a decision about whether a stock is over or undervalued, all these different computers and AI models and whatever have access to the same data. And that's what makes the stock market so efficient and why index funds are so important, because you're not going to beat out a supercomputer that's actively watching every single data point all at the same time and can make the trade instantly. These supercomputers can react instantly. I am not surprised when it says 80% of day traders fail within a year. It is very challenging, if not impossible. This trading route and that 80% failure rate is why I'm so grateful that I avoided apps like public.com or Robinhood, and why I'm grateful that I moved on from them. It's why in my previous episodes and any episode going forward, you're going to hear me talk a lot about investing with a long-term approach. A few of the articles coming up are going to actually show you how much better off you are investing for the long term than trading your money, and I have some charts to prove it. So let's keep this moving with some more stats about how you should avoid trading, which is essentially gambling with your investments. So I have a picture that I want to put up on screen that talks about how 99% of traders fail. So it starts out saying 100% of traders want to get rich quick, which I agree with. And then it says 60% quit after 1 month, 80% quit within the first 2 years, 7% remain after 5 years, and only 1% of traders profit net of fees. Because that's an important thing to watch too, is as you're generating these trades, there's still fees happening with them. So that's another thing to consider. So how hard is it to be among the 1% of any group? Extremely difficult, let alone the 1% of a type of group that takes a lot of skill, expertise, luck, and just good timing. Honestly, trading just isn't worth it. This image that I have on screen, that paints a grim picture. It's really hard to make it as a day trader and really hard to be profitable in what is essentially gambling on your investments. I like the stat about 100% of traders want to get rich quickly. I think that is what leads people down the path of trading, because it's extremely dangerous. It's a very treacherous road to go down because it's very unlikely to work out. And then you're left sitting there spinning your tires, doing nothing because you feel like you need to keep throwing money at your day trading because you want your money back. That's what is such a dangerous cycle. Only 7% of traders remain after 5 years. I believe it. And then even after that, it's still unlikely that those 7% that last 5 years make any money. I hope the research so far is helping you understand how difficult and how hard it is to make money trading and how much like gambling trading can be. This next quote says the average individual investor underperforms a market index by 1.5% per year. Active traders underperform by 6.5%. Now that active trading, that is someone who's doing day trading and trading regularly. Now imagine the market makes 7% in a year. And if you are an active trader, you likely underperformed it by 6.5%. That means you made 0.5% on your money, which isn't even enough to beat inflation. Not only are you not getting rich quickly, but you're getting poor quickly too, because inflation is taking your money away. You're actually getting poorer if you are trading your money regularly. And when I was writing this section up, I could feel this really just bringing up some energy in me, because I think this is something we need to avoid. Please avoid day trading. I'm going to show you exactly why it's so important for all of us to realize this now, because this is so prevalent for our generation. There's so many apps like Robinhood and all these different trading apps that just want to make money off your back and make money off of your trades, that if you can avoid them and truly invest for the long term, you are going to be set up with an abundance of opportunities if you can avoid trading and trying to actively win in the stock market, which is what I feel like so many people think is gambling, and you can completely avoid it and still make money investing. The next quote here talks about who this is most often for. It says, men trade more than women and unmarried men trade more than married men. Poor young men who live in urban areas and belong to specific minority groups invest more in stocks with lottery type features. This is the huge problem with day trading. It preys on a group of people who need their money more than anything. When you're just getting started in your career, any extra money helps. It helps you get going. It helps you get some investments going. It helps you find an apartment. But these trading apps just want to take it all away from you. It is incredibly unfortunate that these trading platforms and lottery type apps target groups in the worst type of financial situations. But that's who they make money on, because that's who they get these addictive behaviors entrenched in their mind, making them think they need to chase the next hot stock that's going to win it big for them. But so often that is so rare and so unlikely. So that's why we need to avoid it. The next quote says the average day trader loses money by a considerable margin after adjusting for transaction costs. Please don't think that you're going to be the one person that makes out of this extremely rich and that you're going to be super unique and profitable in day trading. The next quote says it's very obvious to tell why traders fail. More often than not, trading decisions are not based on sound research or tested trading models, but on emotions, the need for entertainment, and the hope to make a fortune in no time. So guess what? You're going up against computers that are using the research and that are using sound trading methods, and all that information is instantly accessible to these computers. But then these trading apps hope to prey on us and make us think that, oh, it's going to be an emotional driver. You're going to have a hunch what thing to invest in, or you're going to have a hunch on the next big stock. Because if I haven't painted enough of a picture for you yet why to avoid day trading, let's keep going. I want to show you some specific stats about why day trading is so bad. And I want to show you some of these hard-hitting stats. And I'm going to show you in this episode as well how to invest for the long term so that you can avoid this day trading strategy, because it's not going to work for you. And I have some specific portfolio recommendations for you from Fidelity that are going to help you get that investing account started today. So the next couple quotes I'm going to share here on screen are some stats. This first one says that a significant portion of online traders are in the 18 to 34 year age bracket, with an increasing number of women participating. And that's the whole point of this podcast. I want to help catch you before these trading platforms do and before you fall into this demographic that's trying to day trade. Please slow down, take a step back, and use the rest of this episode to help you figure out how you can invest for the long term going forward. These next two stats say that one study from the University of California indicated that a mere 13% managed to maintain consistent profitability over 6 months. It's so hard to stay profitable. Next quote says a report by the Financial Industry Regulatory Authority, or FINRA, in 2020 conveyed that a whopping 72% of day traders ended the year in a financial deficit. 72%. That is very high odds that you're going to end the year in a financial deficit. The data shows that you're not going to make money day trading, so please don't bother. And if this is something you've already been doing, please stop, take a deep breath, and listen to the rest of this episode as I outline for you how you can invest for your future and set up a long-term investing strategy instead of a gambling day trading strategy. But there is one app that is especially bad for our generation, and I want to make sure to warn you about this one. It's Robinhood. Robinhood is the worst at making investing seem like this big game and that it's so much fun, and they make it seem so much more like gambling. They've been fined and criticized and called out, but they still make it so easy to lose your money by trying to trade on their platform. They have, of course, made more people aware to investing, but I think they've done it in a way that isn't right. And I don't think you should give them credit for leading someone to a bad way to invest. Sure, they got more people aware of investing, but they didn't do it in the right way. Robinhood doesn't promote investing, they promote trading, which just makes them more money. If you have money with Robinhood, just leave it there and go start an account somewhere else, and you can worry about that money with Robinhood later. Either invest it in your strategy because they do still have index funds on the platform, or you can roll it over to your account that you're going to set up after this episode. I have two quotes to share here. The first one says that one of the most dangerous gamification features is the emphasis on trending stocks. Just like you'd see a top 10 score in a competitive video game, apps often highlight stocks with most significant price swings, whether they're positive or negative. This next quote says that these lists promote awful investing habits, especially among young investors who are easy to influence. They may end up pouring money into a stock simply because it went up or down more than others in a given day, always chasing the latest and greatest. And this is why Robinhood is a terrible platform. And this is what I've grown to not like about apps like public.com or all these different investing apps. They try to market to you to trade more, and that's because that's how they make money off of you. These apps are just out to make money off of you. So please avoid Robinhood. And let's also talk about another way that these apps are trying to get you to trade more is through a lottery type approach. This next quote says, "Last but not least, many of these apps include lottery systems that incentivize actions that aren't necessarily in your best interest. They can also make the experience feel more like gambling than investing, further numbing users to the risks that are actually involved. For example, Coinbase sent out an email about their latest sweepstakes. They're going to give away $500,000 in prizes to 8 lucky winners, and to enter, you just have to execute a trade of $100 or more. If your investment platform ever offers you some sort of reward or entrance into a big competition for executing a trade, run away. That is not right. That is deceptive and manipulative. The example that I showed of Coinbase offering $500,000 worth of prizes to a group of people who executed a trade should be downright illegal. It's downright manipulation. Your investing should not be decided based on whether you're going to be able to enter this big lottery or not because you made a trade. And these companies, they just want you to continue trading because that's how they make money. When you initiate an order through Robinhood, they send your request to a third-party market maker. The market maker facilitates the transaction, profiting on the difference between the price that party A pays for the shares and the price that party B sells them. The market maker then pays a portion of those profits to Robinhood. But now these apps that have a middleman or they're trying to facilitate the trade for you, they are pushing investments that are going to make them more money. You always have to look at how these companies make money. Why would they not promote on their top 10 leaderboard all these stocks that have big swings so that you're more likely to pump money into them in order for them to make the money on the difference in your investments and make profit on that spread? Because that's how they make money. It always comes down to how these places make money and the conflict of interest that they have. And their conflict of interest is to push trading more and more. That's why Robinhood and these other trading apps can be so bad. I cannot say it enough. Please avoid trading and avoid Robinhood and avoid these apps that are trying to push you to just trade your money more and more every single day. So now I can get off my soapbox about day trading and let's get to the part where you learn how to actually invest. It's all about picking a long-term strategy. You don't have to do anything fancy like picking the perfect stock. Use an index fund approach and keep it simple and easy for the long term. Here's a chart on screen about S&P 500 returns over the long term. It goes 5 years, 10 years, 15 years, 20 years, and then we have best returns and worst returns. So in a 5-year time horizon, the best return was 30% and the worst return was negative 6.6%. Over a 10-year time horizon, the best return was 20%, the worst return was negative 3%. Over 15 years, the best return was still 20%, but the worst return was 3.7%. And then over 20 years, the best return was 18% and the worst return was 6.4%. You're telling me that the worst return over 20 years still makes you money? We're going to come back to that later. But that's how good index fund investing may be able to be for you, is that over the long run, it's still going to make you money, even in the worst possible scenario. This last article that I have some quotes from comes from Fidelity, and they're going to help teach us how to invest for the long run. Couple advantages of a buy and hold long-term approach are 1, compounding, 2, lower transaction costs, and 3, tax efficiency. As far as compounding goes, your money is going to be able to grow. It'll probably earn some amount of dividend, and it's going to continue to grow and grow, because the exciting and super fun part is when you get to see those $20 or $50 or $100 dividends come into your account, because that's real money. It's real money that you're getting back and you're able to reinvest, and it continues growing and continues compounding on itself. A buy and hold approach also has a much lower transaction cost because frankly, there's next to no transaction cost because you're not constantly trading all the time. But when you're only investing once a month with your regular contribution, you're not racking up a whole bunch of transaction cost fees that apps like Robinhood are trying to profit off of. And then there's the tax efficiency piece. Go back and listen to my previous episode about taxes, because that's going to cover a lot of what you could do with tax efficiency in your investing accounts. Because you could potentially capital gain harvest every single year and pay 0% taxes on your capital gains. And if you're interested in paying 0% on taxes, leave a comment down below and I'd love to help you figure out how you can do that. But go back and listen to my episode on taxes and it's going to explain the whole process to you. Now, of course, there are some risks to a long-term approach, but I'm going to help you understand that they're not that bad. 1, bumpy markets, or the up and down of the stock market, right? 2, knowing when to exit. And 3, overconcentration. These sort of risks are always mentioned when it comes to investing for the long term because frankly, you need to be aware of them. But honestly, I don't think they're a risk. A bumpy market, who cares over the long run? Who cares how much your stocks went up and down today, because it doesn't matter, because you don't need the money today. Because in the long run, you're not going to even have to worry about knowing when to exit, because that investment that you made will be up over the long run. Because the longer you leave it, the more likely it is that it's going to increase. Of course, we can't guarantee any long-term return, but if you look at the history of the stock market and how companies are set out to make money, I have a feeling you're going to do okay. But let's talk about the risk of overconcentration. That's why I think it's so important to invest in an index fund, so that you avoid concentration of a single stock. You can invest across the entire US stock market, or even the entire world for that matter. Now, why do you consider a buy and hold strategy? Well, there's 3 reasons I have here on screen. 1, you can avoid the pitfalls of market timing. 2, you can reduce the emotional decision making. And 3, you can stay focused on long-term goals. All of these really hit on the emotions around investing, because market timing, it's extremely difficult and practically impossible. Please avoid market timing. It's extremely difficult, if not downright impossible, and you're honestly not going to be able to figure it out. So don't bother yourself with trying to pick the perfect time to invest, because there's so many emotions that come with that. You make the decision once and then you stick to your strategy forever, and it takes out the emotion of trying to pick and choose what to invest in. And not only are you then able to stay focused on your long-term goals, but you're able to focus on something other than money, because frankly, you don't care about your investments because you know your strategy is going to hold out and work in the long run. And it makes it incredibly easy to not even have to worry about your money or your investments. So what kind of a portfolio do you actually choose for these long-term investments? I'm going to share here on screen 4 different portfolios that Fidelity outlined that talk about a conservative, balanced growth, and aggressive growth approach. I'm going to focus on the aggressive growth one because that's for our demographic, for young adults. And honestly, I don't think it's aggressive enough. I don't think you need bonds. I think you could find a mix of stocks and aggressive investments and be just fine over that 20 or 30-year time horizon. Because if you look at that one that's still a little conservative, the worst it could do over a 20-year time horizon is 2.6% annually. And just like the chart we showed earlier, if you're 20 years old looking at this chart, or the chart that I showed earlier about the S&P 500, you should be thinking, yes, please throw my money into the stock market. Please throw my money into something that the worst it can do is make me money over 20 years. How fantastic is that? When you look at these charts, you think, what's the worst this investment could do? Oh, make me money over 20 years? How cool is that? Because the best it can do is even better and is going to provide you with so many opportunities over that long time horizon. So please make sure you're investing in those for the long term. I love when I can pull out charts like this that show us that the worst we can do is still make money. So please avoid day trading and avoid trying to gamble with your investments, and stick to a long-term strategy. And if you have any questions about how to set up a portfolio like this, please reach out to me. I'd love to sit down and chat with you about how we can start investing for you for the long term. But that does it for today's research. What did you think? Next, I have a great case study that is just like so many of us, how we start investing with these different apps, and then we realize it's not making us any money. So what do you do to actually get started with this simple and long-term investing approach? That's what we're going to cover next in today's case study. So today's case study is going to cover John. John is 26 years old. He's a software engineer in Raleigh, North Carolina, making about $85,000 in his first real job, right? We've all been at this point. He's finally felt like he has enough to start investing. He's heard from all of his friends and on social media that he should make money in the stock market, that that's the place to invest. And John is super pumped to get started with investing, just like so many of the rest of us have felt. Where do you actually start? Well, John didn't know where to begin with investing. He had no investment experience, and his parents never taught him about money, just like so many of us. He didn't know what a 401k was, or really what anything beyond a savings account with his credit union was. He didn't know what a brokerage account even meant. But then he kept seeing some advertisements for these sleek, fancy-looking investing apps, and he finally decided to open one. They were marketed that they were commission-free and that he would finally be able to do free investing. And that seemed cool, right? Everything on the app seemed so simple. John didn't have a clear strategy, so he wasn't sure what to do. So he relied heavily on the app's guidance. And the app decided to promote trending stocks and promoted stocks that were being traded frequently and showed him other users' trades like Robinhood or public.com, like those apps that I mentioned. He was constantly getting bombarded with phone notifications about this new, hot, trendy stock that he needed to invest in right away, or he was going to miss out on the gains, right? He felt like he was doing everything right because that's what the app told him to do. It's what he was educated to do because There was no sort of education that he had growing up, or no sort of education that he got in college or from his job or from his parents. Nobody educated him on what to do around investing. So over the next few years, John became increasingly active on the platform. He was buying the trending stocks that were the next big thing, right? He was convinced that he was going to be able to time the market. The app had convinced him that he was going to be able to hit that big money winner, right? He was going to catch that next big winner and become rich. And then the app decided to introduce crypto trading and options trading. And that's when he got even more excited about the potential for these quick gains. He was super excited that these options trades were going to allow him to make so much money. And he was excited to start investing in all these new different ways. And of course, like all of us, crypto shows up on all these different apps and you have no idea what to do with it. Is it actually an investment? Is it just speculation? John was on these apps all the time now. He was trading multiple times a week and he was logged into it, looking at his phone, looking at his different trades all the time because he wanted those quick, promised big gains that he was being told about from the investment app. And he would just continually see his money go down, or he would lose out on his options trades, or his crypto that he found would suddenly go to zero. It was constant anxiety. It was constant stress. He was always stressed that he would log into his app and see his accounts go down and that they would really never go up again. This anxiety left him feeling like there was something that he should have been doing differently with his money. And this is where that clicking point begins to happen for so many of us. The constant anxiety, the constant worry, the constant stress around our investments and our trading makes us feel like we're missing something, right? Why is this app causing so much stress in my life when it's supposed to be causing me to get rich and wealthy and profitable over time? So that's where John started to realize that something might need to be different, that something might need to change. So after years of actively trading, John sat down and decided to go through his different financial statements from his investing app, and he tried to calculate his return. And he was shocked to realize that the money he had put into the account had barely grown. He had only made about 3% over 2 years. To put that in dollar terms, if he put in $10,000, he only made $300. And that kind of a return over 2 years, it's just sad. He could have made more money at a bank. He should have made a ton more money than just 3%, considering the massive amount of risk he was taking with these different crypto trades, these different stock options. He was taking so much risk, but he was left with only 3% return. That's how so many of us feel. We're wondering, why am I not getting wealthy? Why am I not making money investing? And that is where the gambling idea comes into play. And that's the thing we need to avoid. That's why we need to avoid trading and why we need to plan on investing our money instead of just trying to speculate and essentially gamble it away. So John decided to look up what the S&P 500 did during the same time frame that he had been trading, because he had heard a lot of his friends mentioning the S&P 500, and a couple of them were saying that's all they invested in. So over that same time frame in John's situation here, the S&P 500 returned about 24%. That means that same $10,000 could have made $2,100 more dollars if it was just in the S&P 500, and he left it alone. He didn't even have to trade regularly. He wouldn't have had to deal with that constant anxiety and stress that he had every single day hoping his trades went up. This led John to feel frustrated and discouraged. Just like all of us, I would feel frustrated and discouraged at this point if I learned that something as simple as the S&P 500 would have made me so much more money. He thought this whole investing thing was going to be the key to building wealth, right? But he got nowhere. What is he supposed to do now? How do you actually move forward once you realize these trading apps aren't in your best interest? How do you actually move forward and be able to reach your financial goals and start a real long-term investing approach? So this is where I step in. This is where you could work with a professional. This is where you could listen to the good financial education podcasts out there. And if you've ever found yourself in a similar situation to today's case study, please reach out. I'd love to sit down with you and help you overcome the challenge that trading has left you in and start finding a real investment strategy that's going to help you build wealth instead of just spinning your wheels trading. So what is the advice in this situation? The first thing, of course, is to figure out when you're going to actually need the money. For most of us, it's going to be a very long-term approach, so we're going to assume 30 to 40 years. And that's going to lead our portfolio to be similar to the one from Fidelity. That's that aggressive growth portfolio. So let's choose something simple, like a total US stock market fund and a total world fund. I'm going to give you two tickers, and when I say a ticker, that's just the identifier for the stock you're investing in. Think like a barcode for a thing at the store. A ticker is the thing you give to your investment account to tell them, I want to invest in this particular index fund, stock, mutual fund, whatever it may be. The two tickers that I would recommend you look into are VTI and VXUS. Both of these are ETF index funds. You can look up what an ETF is, but it's just an easier option to trade than a mutual fund. If you don't want to look it up, just go with the ETF index fund and you're going to be okay. So now, if we're being honest, John or you could still invest through the trading app that you were originally trading on because it's very likely that VTI and VXUS are both available there, but I would recommend to simplify this even further. Let's start by opening an account with one of the large brokerage firms out there. And when I say brokerage firm, that's essentially like a bank for investing, just to keep it simple and to not bore you with the explanation. I would recommend Fidelity or Vanguard. You might be asking which one. Either is fine. It doesn't really matter. Don't think about this one too much. Go watch one YouTube video comparing the two and just choose one. I personally like Fidelity, so if you want my recommendation, go with Fidelity. I've always had a great experience with them. So now you're going to open the account and start setting up your investment allocation. It's really just as simple as you click trade, you type in VTI, and you put the dollar amount you want to purchase, and then you place the trade. Then you do the same thing. You type in VXUS, you place the dollar amount you want to buy, and you click trade. It's really just that easy. The real piece of the strategy comes in figuring out how much money you can contribute regularly, because once you have your strategy locked down, it's easy peasy, and you just have to keep throwing money into the account. Because for John and so many of the rest of us young adults, it's all about those regular contributions. It's all about making sure you're shoveling as much money into the account as possible. Because now that you have this set up, you don't have to worry so much about trading regularly. You make your contribution, you place your trades, and you're good. So now what do you do with the money that was at the previous account? Well, you could just leave it there and forget about it and hope it goes up over time. You don't really have to sell it all or do anything right away. You can leave it be and that's okay. You could sell it if it's gone up, cash it out, and put it in your other investment account. And the reason I say sell it and cash it out, because the thing that is tricky is you could technically do an account transfer to continue your ownership in those stocks. But all of these different apps are going to make money off of you by charging you a sizable fee to transfer your account. So it might just be better to leave it and worry about it later. But now you have a super simple and easy approach going forward. And all there really is to do is to just identify a few funds and continue shoveling regular contributions into your investments, and you're going to do just fine for yourself. And that does it for today's case study. I really hope that helped you understand how so many of us have faced the same issue of being trapped in these trading apps and our money going nowhere. And I hope you were able to understand that there's a different way to invest instead of trading and essentially gambling on your investments. And I hope you enjoyed today's episode. We're going to wrap it all up next. The action item from today's episode is to go this week and open an account with Vanguard or Fidelity and start investing in index funds like VTI. So let's stop worrying about trying to trade our way to wealth and commit to a long-term investment strategy. If you need help setting this up, please reach out to me. I'd love to sit down and talk you through some basic and simple investing so that you can get this set up for yourself, because it doesn't have to be complicated and it can be a whole lot easier than any of these trading apps make it out to be. So let's make it so that you don't have to worry about your investing or which stock to pick or when to sell your investments. We can set up a system for you that is that true set it and forget it approach that everyone craves and everyone wants. So please reach out today. And I hope you enjoyed today's episode. We covered a lot, from how I also fell victim to these trading apps in the very beginning to how trading isn't going to make you wealthy, with a lot of research in today's episode. And then today's case study that walked you through a situation that's so similar to so many of us and how you can make the change to invest in a way that's truly for the long term. So go out and get this set up for yourself today so that in 20 or 40 years, you can have more money and more opportunity than you could ever imagine or know what to do with. I hope I was able to make the seemingly complex world of financial planning a little clearer for each of my fellow money buddies. I'm your host, Skylar Fleming. I hope you have a great rest of your week. And hey, quick heads up. This podcast, it's meant to be educational and it's for entertainment purposes. It's not personalized financial advice for your specific situation. So before you go out and make any big money moves, make sure you chat with a qualified financial professional who knows your full financial picture.